The National Treasury has acknowledged the role alternative investments can play in an investor's portfolio. It recently published draft legislation that could see hedge funds made available to the broader investing public early in 2014. Here to discuss his views on the industry and give us an update on the activity in the nitrogen hedge fund is Rowan Williams. Rowan, thank you for your time. Let's begin with just a look at what the government is proposing. Is that a good thing?
I think it is a good thing. Hedge funds overseas are reasonably mainstream. They obviously make a lot of news and in the press a lot, but actually in South Africa it's still quite a small industry. There was a recent research report on the industry that came out, and assets under management are around 33 billion. So you can see there's huge scope for growth. And I think there is a lot of investment talent, investment management talent in the industry.
Yeah.
And we could benefit, I guess, the broader investment community by playing a bigger role in managing
That
savings.
was going to be my next question. I was going to ask you what the position is of the industry in terms of what is being proposed by government, because we do know that there have been calls abroad that there be more regulation and perhaps tighter regulation of the industry given what has happened in the past.
So I think that's this proposal on regulations stems from developments in the overseas markets, where there have been a number of introductions of more regulated hedge fund type products, and we're coming into line with that. So the industry itself, I think, because we're seeing the developments overseas, we obviously are aware that they're likely to be coming in South Africa. So there's been, I think, a very good engagement process with representatives from the industry. There are a number of different players, and ASISA has been leading that engagement with National Treasury and the FSB.
Right.
So we've been part of the process. But obviously the government are going to put out what they think is best for the public sector, or for the public.
Yeah.
We think it's broadly positive in that it brings hedge funds into the mainstream, as you said, and it gives us access to a greater investment community, particularly retail investors. And I think there have been a number of institutional investors that have probably been sitting on the sidelines because they're concerned about the lack of regulations of hedge funds.
Warren, before you come in with your question, I also wanted to ask you, actually, should the industry be scared?
No, I think that the industry's been pretty well regulated. I think we've had a couple of blowouts, and we've also learnt a lot about what's happened overseas. So I think the question to Rowan is, in the current form that you run a hedge fund, or many hedge fund managers like yourself run their hedge funds, the new regulations that would make a retail version of your fund available. What do you think about some of those restrictions? And if you could just describe some of those for our viewers in terms of, is it going to water down what hedge fund managers can really do, or and make it like a hedge fund light, which it's neither a kind of very retail product nor allowing you to be a proper hedge fund manager? What are some of your feelings about that?
Okay, so yes, so as you mentioned, particularly there are two proposed products, a restricted product and a retail product. The retail product is fairly restrictive in terms of particularly the risk parameters in terms of the fund and how it's managed, and I think the regulations specifically focus on the risks in an attempt to manage the risks, and that's obviously to shield the broader sort of investors from the potential risks in a hedge fund. Now, I think a good hedge fund manager is already a risk manager, so you're putting further restrictions on that, and to some extent that's where they've probably gone a little bit overboard, in that you're going to lose some of the benefit of a hedge fund, which is to be able to use the hedging process, long and short, and the leverage to generate the returns, but in quite a low-risk methodology. And those have been watered down, where you can only go to a maximum of, say, 2 times leverage in the fund. You have to run with a number of different counterparties. You also have to report on your risks and your investment process very transparently, which obviously some hedge fund managers won't want to do. So I think there's going to be quite a lot of comment coming from the industry, specifically on that product. The restricted product is less restrictive, notwithstanding the name, which gives a little bit more leeway. But I think they've made it's good to have the regulated products, but they may have gone a little bit overboard in terms of the restrictions.
I have a solution.
Okay.
Why shouldn't they just worry about tying performance to the fees? So in other words, as long as you're outperforming whatever your benchmark is, charge as much as you like.
Yeah, so look, that is largely how the hedge fund industry is structured. It's performance fee based, and the managers don't earn performance fees if they don't perform and they don't beat a hurdle. So there is that form of self-regulation, and also most hedge fund managers have a significant personal or company investment in the portfolio, which should also align the interests. I think there's an issue where you've got some moral hazard because also of the performance fee structure. Guys maybe chase for big returns, use a lot of risk, and which may work for a while, and then there's significant losses.
So just in terms of that, Rowan, with the fund you run, and maybe we can move into what the nitrogen hedge fund's been doing now, is the retail option a viable option for the type of fund that you run in terms of your long-short equity fund?
Yes, so our fund, it's I guess it's not unique, but it's a fairly low risk fund. So we run at a maximum of 2.5 times leverage. And if you look at the requirements for the retail product, and I'd say that's sort of the biggest restriction, is the maximum leverage would be 2 times for the retail type product. I think we could largely achieve a lot of what we're doing in the nitrogen fund in a more restricted mandate. So we would obviously have a different mandate if we were to offer a retail product, but we could largely mimic, I think, the profile of the returns that we have so far delivered to broader institutional investors. So it would be a real potential for us.
Rowan, I must say you've been doing a good job, and it's not my job to praise people, and actually when they come here we examine them and we try and find loopholes in which they're not doing things right. But your return since inception, excellent, 153% versus the all-share index of 100%. Let's just begin perhaps with the broader discussion of investment strategy.
Okay, so as you mentioned, we do look to outperform the market, the broader equity markets over a full cycle. Yeah, that would be the all-share index. And the strategy or the structure of the fund, what we're looking to do is try to produce about 2/3 of the upside of the market, but almost none of the downside. And if you're able to achieve that, you will largely outperform the market over a cycle. So obviously in a strong bull market, you may underperform because you hedged and you don't have that full market exposure, but you're protecting capital when there's a large pullback in markets, and in that way outperform the market. So we use quite a strong hedging process in order to do that. So we have...
So sorry, Rowan, just to get that right, so you're running a long-only book in much the same way that many long-only unit trust funds are going out. You're going and looking for undervalued companies.
Yes.
And then you, on your short book, which can take advantage of mispricings between two companies, and you can also build in the protection there. That's really where you try and manage the volatility. Is that right?
Yes, yeah, that's right. So you get some market exposure, and all the shares that you like, that you basically long, you would hedge out a portion of that exposure. So you could do it in 2 ways, and we do that. So you can look for what we call naked shorts, I guess, which are shorts that are absolute shorts you're looking to make a profit on, in that you believe the company is absolutely overvalued and will underperform, will actually go down in value, and you will make a profit on it. But also then a number of shares that are merely hedges, which means they won't go up as much as your long position, and that's how you'll make money. Or they will go down, I guess in a downturn, they'll go down more than your long position does. So even if your long position went down 5%, but the short went down 15%, you're still going to make a 10% return on that pair type relative value trade.
So timing is critical here. So read this market for us if you can, Rowan. Where exactly are we? Are we in a bull market? Are you trying to find your 2/3?
Yes, so look, it's been a very interesting period and a very interesting few weeks. And just to give you anecdotal evidence, say on this last week. So we've had a situation where you're seeing, I think, deteriorating demand. Obviously, the mine strikes are weighing heavily on the local economy and are clearly going to have an impact on GDP growth. And you're starting to see a softening local economy. Obviously, we've got weak developed economies, but early this week, the new car sales came out, up 1.4% on last month, the same time last year. So very soft, and actually down on August. And then the PMI number, Kagiso PMI number came out, and that was also negative and quite below expectation. But what happened to markets, and mainly domestic stocks? They started to go up. And then that was compounded yesterday by a speech by Jill Marcus saying that the rates decision that they announced last month was very difficult, implying that there was a strong potential for a rates cut come at the next meeting.
Right.
So you actually saw weak economic data resulting in the stock market moving upwards, and mainly the local stocks.
So how to read it? That she's going to cut, and therefore that's going to be beneficial to the market, and therefore you are saying this market is pointing up.
That's basically the thesis, correct, yes. And it's amazing that you're seeing weak economic data being supportive of equity markets. And I think we've seen that for some time also globally, because it results in the need and the likelihood of further stimulus, monetary stimulus. And it's that monetary stimulus really, low interest rates, continued quantitative easing, bond buying, that is continue to underpin this market and probably drive it upwards.
I suppose don't worry about the inflation down the road.